A dividend ladder is one of the most powerful strategies you can build if you want a way to earn money, even while you sleep, because it is a simple, long-term method of investing in dividend-paying stocks so that you receive payouts throughout the year, quarterly, or even every single week, creating a consistent stream of passive income that grows over time. And it works by spreading your investments across companies that pay dividends in different months. So instead of receiving all your payouts at once and then waiting for the next cycle, you create a steady rhythm of income that continues throughout the entire year, which is especially valuable for people who want financial stability, predictable cash flow, or early retirement plans. Because unlike relying on capital gains, dividend income arrives regardless of market ups and downs, as long as the underlying companies remain strong. And to build a dividend ladder, the first step is choosing reliable, stable companies with a strong history of paying dividends. Looking for businesses with consistent earnings, low debt, healthy cash flow, and a long track record of rewarding shareholders, often found in sectors like utilities, consumer staples, telecommunications, energy, and financial services, while avoiding extremely high-yield stocks that look too good to be true because they often signal struggling companies and dividend traps. The second step is checking each company's dividend schedule, whether quarterly, semi-annual, annual, or monthly, to ensure their payout months are spread across the year. So, for example, Company A pays in January, April, July, and October, Company B pays in February, May, August, and November, and Company C pays in March, June, September, and December, allowing even 3 strong companies to create a basic 12-month ladder. The third step is deciding how much to invest in each stock, remembering that you do not need a lot of money to start, because small, consistent purchases build a powerful ladder over time, especially when using dollar-cost averaging to reduce risk and accumulate shares. And the fourth step, arguably the most important, is reinvesting your dividends, because reinvesting allows your dividends to buy more shares, which then produce more dividends, creating a compounding effect that accelerates your income growth automatically. And many brokerages offer DRIPs, or dividend reinvestment plans, which reinvest dividends instantly for faster portfolio growth. And as your ladder expands, your income becomes stronger, smoother, and more predictable, especially when you diversify further by adding dividend-focused ETFs that spread your money across many companies to reduce risk, or REIT, which pay higher than average dividends because they must distribute most of their profits to shareholders. Though it is important to balance high-yield assets with stable, low-risk companies to keep your ladder strong during economic downturns. And while building a dividend ladder is not a get-rich-quick strategy, it is a long-term system that rewards discipline, patience, and consistent reinvesting, ultimately providing a reliable stream of income that supports your financial goals, reduces money stress, and helps you build wealth in a stable, predictable way, so that whether your goal is extra monthly income, retirement security, or long-term financial independence, a dividend ladder is one of the simplest and most effective strategies you can use. And by starting small, staying consistent, and reinvesting your dividends, you can watch your income grow steadily year after year.